entity, and that is an entity that must or chooses to prepare financial statements. And this entity can be single entity, one company, or even a portion of an entity, for example, some division of one company, or more than one entities, for example, parent and its subsidiary. As a result, we have few types of financial statements: consolidated, where parent and subsidiary provide information as a single reporting entity; unconsolidated, where parent alone provides the financial information; and even combined financial statements if a reporting entity comprises two or more entities not linked by parent-subsidiary relationship. Chapter 4 is about elements of the financial statements, and they can relate to the financial position. Here we have assets, liabilities, and equity. And another elements relate to financial performance, and these are income and expenses. And then the framework defines each element and provides examples. It is a very extensive chapter full of details and lays good foundation to is about recognition and derecognition. Recognition means inclusion of an element into financial statements when it meets the definition. And it links the elements in the statement of financial position and the statement of financial performance as follows. Well, in the statement of financial position, at the beginning and at the end of the reporting period, assets minus liabilities equal equity. And we have also income minus expenses recognized in the statement of financial performance, and contributions from and distributions to holders of equity. And these two items are recognized changes during the period. Derecognition is the removal of all or part of recognized asset or liability from entity's statement of financial position, and framework sets a number of criteria for both recognition and derecognition. Chapter 6 talks about the measurement. So while recognition means when or whether to recognize, measurement means in what amount to recognize. More specifically, the selection of a measurement basis, well, which is a way of measuring monetary amount for elements of financial statements. And the framework discusses two basic measurement bases, which is historical cost, that's basically the transaction price at the time of recognition of the element. And the second one is current value, which measures the element updated to reflect the conditions at measurement date. And here it includes fair value, value in use, and current cost. Framework then discusses many factors to consider when you're selecting the appropriate measurement basis, and the most important is to make sure that the financial information is relevant and provides faithful representation of the financial performance and position. Well, but there are also factors specific to initial recognition, enhancing characteristics, and other that are discussed by the framework in detail. Chapter 7 is about the presentation and disclosure. So presentation and disclosure are communication tools, and in order to make the communication effective, it requires focusing on presentation and disclosure objectives and principles, not the rules, and then classifying the information so that similar items are grouped and dissimilar ones are separated. And here the framework speaks about offsetting, classification of equity, income and expenses, and other items. And finally, aggregating information, but need to prevent too many unnecessary details, and also the opposite extreme, over-aggregation. And then all these concepts are discussed in detail. 8 is about concepts of capital and capital maintenance. It is essentially copied from previous version of framework, so nothing new here. Well, framework explains two concepts of capital. Financial capital is synonymous with the net assets of equity of the entity. And under the financial capital maintenance concept, the profit is earned only when the amount of net assets at the end of the period is greater than the amount of net assets in the beginning, after excluding contributions and distributions with equity holders. And this financial capital maintenance can be measured either in some nominal monetary units or units of constant purchasing power. Physical capital is regarded as the productive capacity of the entity based on, for example, units of output per day. And here the profit is earned when its physical productive capacity increases during the period, of course, after excluding the movements with equity holders. And the main difference between these concepts is how the entity treats the effect of changes in prices of assets and liabilities. So that was a short summary.